Hello everyone. Today's topic is PE ratio, that is price to earnings ratio. In today's session, we will discuss what is PE ratio, the calculation of PE ratio, the uses of PE ratio, some of the examples of PE ratio, and what are the factors that we have to consider while comparing the PE ratios of different companies belonging to different industries. Coming to the question, what is PE ratio or what is a price to earning ratio? So, price to earning ratio refers to how much price we have to pay to get 1 rupee earning from a company. So it compares the PE ratios of two different companies. So we will compare the PE ratios of two companies and see which company's PE ratio is lower. And we have to invest in that company which has a lower PE ratio. Calculation of PE ratio. What is the formula that has to be used to calculate the PE ratio? So in the PE ratio, there are two factors that we have to consider. That is the share price and earnings per share or EPS. So let us say for a particular company, the share price is rupees 100 and EPS is rupees 5. So PE ratio is equal to current market price of one share divided by earnings per share. That is equal to rupees 100 divided by rupees 5 is equal to 20. Uses of PE ratio. Let us understand the PE ratio with the help of a simple example. Let us say we have two options. That is to buy a building worth rupees 10 lakh or to buy a building worth rupees 12 lakh. The building with 10 lakh will give us a monthly rental income of rupees 10,000. And the building with 12 lakh investment will give us a monthly rental income of rupees 15,000. So here we have to see 10 lakh divided by 10,000. And for the second building, 12 lakh divided by 15,000. So then we have to, if we compare, that second building will be available at a lower cost because its returns is high. So the second building will give us the higher value and the second building is more preferable. So when considering an investment, we should not only see the investment that we have to make, but also we have to consider the returns that we will get from that investment. So while talking about the PE ratio, we talk about the industry PE. So for different industries, the PE ratio will be different. For automobile, that is the auto sector, the PE ratio will be different. For consumer companies, the PE ratio will be different. For cyclical stocks like metal stocks, the PE ratio will be different. For automobiles like Eicher Motors or TVS Motors, Hero Honda, Maruti Suzuki, the PE ratio will be around 20 to 30. For consumer retail companies like Shoppers Stop or Trent, the PE ratio will be around 100. For cyclical stocks like metal stocks like Tata Steel, Hindalco, the PE ratio will be around 10. So you have to compare the PE ratio of Tata Steel with that of the Hindalco. You have to compare the PE ratio of Trent with that of the Shoppers Stop. You have to compare the PE ratio of Eicher Motors with that of the Maruti Suzuki. So some industries have high PE ratio and some industries have low PE ratio. For example, the textile industry, the metal industry have low PE ratio. On the other hand, the consumer retail have higher PE ratio. So the PE ratio will be different from industry to industry. Let us understand the PE ratio with a standard example. There is a company limited, and for that company, the EPS and share prices and PE ratio for the first year, second year and third year are given. So the EPS goes on decreasing. So first year it was 20 rupees, then it became 15 rupees, and in the third year it became 10 rupees. And share price rupees 200, rupees 195 and rupees 180. And PE ratio also started to increase from 10 to 13 and from 13 to 18. So in this company, the PE ratio has increased consistently. So that means the company is overvalued. The company is not available at a cheaper rate or at a lesser rate. So it is not a good investment because the PE ratio is increasing. Let us see the next example. B Limited company, the EPS has increased consistently in the 3 years from 20 rupees to 40 rupees to 80 rupees. The share price for the 3 years is same, 400 rupees. And so, because the EPS has increased, PE ratio has come down from 20 to 10 and from 10 to 5. So, because the PE ratio has decreased, it is a good investment. So, a lower PE ratio is a good signal. A lower PE ratio indicates that the share is available at a lower cost, it is undervalued, and you can invest in that stock. We should also consider some other factors while comparing the PE ratio. We should not focus exclusively on PE ratio. So look at this example. X company limited, and the EPS in the first 3 years has increased from 20 to 21 and from 21 to 22 rupees. And the share price also increased marginally from 200 to 210 and from 210 to 220 rupees. So PE ratio is the same for the 3 years, that is 10. So this is a low PE, low growth company. The Y company limited, the EPS has doubled every year from 20 rupees to 40 rupees and from 40 rupees to 80 rupees. The share price has more than doubled each year from rupees 300 to rupees 1000 and from rupees 1000 to rupees 3200. So this is a high PE, high growth company, and that's why the PE ratio has also increased from 15 to 25 and from 25 to 40. So looking at this, we cannot say that we should not invest in Y company limited, because in high growth sector, high growth industries, the PE ratio tends to be high. That does not mean that it is less attractive or you should avoid the company, because in high growth sector, the investors discount the future. They predict that in the coming years, the company will grow even further, and that's why they give high valuations for these stocks. So it is very likely that the high growth companies will continue to grow further, and you can consider investing in these companies even though the PE ratio is slightly high, because the EPS is also increasing. As we have already seen, there will be high growth companies and there will be low growth companies. Sometimes high growth companies will be available at a lower PE ratio. The share price will decrease due to some reason for the high growth companies. So at that time, these stocks are called as value stocks, and at that time you can buy these stocks. And also sometimes the low growth companies, the PE ratio becomes lower, means the share price might increase. Then we call it as overvalued stocks, and we have to avoid these overvalued stocks. And if the two companies belong to the same industry and if they have equal growth rate, we have to invest in that company which has a low PE ratio. Another factor to consider while focusing on the PE ratio is the historical average PE ratio. Suppose we are considering about investing in a particular company, then we have to compare the current PE ratio with the historical average PE ratio. That is, we calculate the PE ratio average for the last 10 years. Let us take an example. For AB Limited, that average PE ratio is 25 and the current PE ratio is 10. That means for some reason that stock is available at a lesser cost because the PE ratio is only 10. So we can invest in that stock. Let us take another example. Let us say that the average PE ratio is 25 and now the stock is trading at 35. That means the stock is overvalued due to some reason. So we have to avoid this stock. So PE ratio is an important ratio which says the valuation of a particular stock, whether the stock is undervalued or overvalued. A high PE ratio indicates that the stock is overvalued. A low PE ratio says that the stock is undervalued and we can invest in that stock. Thank you.